This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set to catch a tailwind from Wall Street, where dip buying fueled a rebound in the S&P 500. Treasury is extending a drop on bets that the Fed may stay on pause most of the year. Also ahead, Donald Trump's team said to be looking at ramping up new tariffs month by month, seeking ways to avoid an inflation spike. South Korea's constitutional court to begin deciding whether to remove President Yoon from office over his martial law declaration. Plus, we are live at the UBS Greater China Conference and Goldman Sachs Global Macro Conference to talk market strategy with both of the bank's chief economists.
Heidi, we saw a little bit of a rebound in the overnight session on Wall Street, but this, of course, the caveat is that the global bond rout continues, and that's really pressuring the stock markets. Of course, we do have the earnings season starting this week with big banks, not to mention that we also have to contend with the Fed's easing path. So investors have a lot to digest at the moment, but suffice it to say that right now, given the pressure in the stock markets, we're almost wiping out the bump that we saw after the election of Donald Trump in November. We're down about 5% from the December highs.
We're, of course, watching China as well, Rab. We've got a couple of developments when it comes to the China securities regulator vowing efforts to stabilise the market at a time where, of course, the sort of macro picture remains very much fragile. We had the Chinese trade numbers coming through, the trade surplus reaching a record $992 billion in 2024. Strong exports, weak import demand. Their exports rising nearly 11% and exports hitting to the US almost $49 billion. So that trade surplus could really come under threat very quickly by the incoming Trump administration. We'll get more on sort of what their latest plans are in terms of how to dole out these potential trade tariffs soon. But we could see that leading to a decline in the months to come when it comes to exports, particularly to the US. The other piece of news that we're watching when it comes to China, of course, as the MSCI China index enters a bear market, the technical signaling that we're looking pretty oversold after that 20% drop. But the securities regulator now vowing to stabilize the market this year to anchor market expectations. The CSRC saying that they'll work with the PBOC to enhance those policy tools to induce and maintain a positive market momentum. So, you know, easily said than done, right, given the oscillations that we continue to see, not just recently, but over the past few years when it comes to sentiment in China.
Yeah, at least in the near term, it seems that inducing that positive market sentiment might have worked for the Chinese offshore yuan, because we saw it gain against the U.S. dollar in the overnight session. We had the PBOC again coming out with another verbal warning, not to mention announcements of tweaks to capital control rules, trying to support the currency. Take a look at the Japanese yen holding at that 157 level against the U.S. dollar, really range bound at the moment. The Japanese market coming online after a holiday. We are expecting the BOJ deputy governor to speak today, so we'll be watching out for that speech as the ASX 200 right now is gaining 0.25%. But it's really about U.S. dollar strength right now that's affecting all of the currency moves across Asia. We're talking about 5 sessions of gains for the dollar, and Goldman Sachs now actually upgrading its dollar forecast. It sees about 5% gains for the dollar for the rest of the year, given the resilience of the U.S. economy. And those rate expectations, will the Fed be able to ease as fast as they want? That recalculation really leading to that bond rout that we continue to see. We had seen a little bit of upside for the stock market in the overnight session, a lot of dip buying into play, with the S&P 500 managing to reverse almost 1% of losses in the regular session. But it's really about that pressure coming from the fact that yields continue to surge, the 10-year yield really approaching that 5% level, Heidi.
Well, Bloomberg has learned that Donald Trump's economic team is discussing a gradual approach to tariffs to boost negotiating leverage and avoid a spike in inflation. Our editor, John Harney, joins us now for more. So what are we hearing in terms of, I guess, the strategizing, given so much of these market concerns are really tied to what a huge inflationary spike we could see from trade tariffs?
Well, first of all, this is all very gradual. As our reporters, Jenny Leonard and Soleil Motion, say, that the president-elect has yet to really see this proposal, let alone sign off on it. But it does indicate a bit of nuance as far as tariffs go, raising them slowly over a period of time with two goals, if you will, in mind. One is to see what sort of reaction they get from whoever is the target of the tariffs. The other is to see what happens with inflation. As you point out, markets have been very jittery about this whole tariff regime that the president-elect wants to or has proposed on the campaign trail, and would like to put in place.
Do we have any idea of the priorities when it comes to implementing these tariffs gradually and what that could mean for the broader global economy and markets? Not to mention that perhaps some of those key appointees for key roles in Trump's cabinet, what that will look like in terms of how this could play out.
Well, Scott Bessent, his nominee for Treasury Secretary, has played a role in this, this idea that's taking shape, and as far as who how this will play out, that's still remains unclear because specifics. Again, the president-elect has not said whether or not he'll go along with this, and fairly recently, Mr. Trump has said we're going full tilt on tariffs. No gradualism, no halfway measures. But many countries have been quite nervous about this, including our neighbors, the United States, Mexico, and Canada.
John Haidi, our Bloomberg News editor, there with the latest on what we can expect from the tariffs from the incoming Trump administration. Turning to South Korea, its constitutional court will today begin hearings on whether to uphold President Yoon Suk-yeol's impeachment and have him permanently removed from office. Our economy and government reporter Soo-hyang Che joins us now from Seoul. And Soo-hyang, we're also hearing that Yoon's chief of staff wants a third-party location in order to be questioned. What can we expect from these court proceedings, especially on the first day?
All right. Of course, the biggest question has been whether Yoon will appear himself at the court hearing. But Yoon's lawyers have been saying that the president will not attend this first hearing due to safety concerns. Remember, as you said, the president is facing a separate criminal investigation over his martial law declaration, and he just does not want to risk the chance of getting arrested while appearing at the court. Now, if he does skip the court hearing, as his lawyers have said, the court will have to wrap up the session pretty quickly, even within a matter of minutes, because the law stipulates that the impeachment trial has to proceed with the impeached person present. The court will be able to proceed further from a second hearing, which is slated for Thursday, without Yoon's attendance. Another uncertainty that we're watching is that uncertainty that we are watching is that Yoon has just yesterday filed a number of complaints, including raising an issue with one of the justices, saying that her liberal background cannot guarantee a fair ruling. So court justices will hold a meeting in a couple of hours to review this complaint. And if they do accept this complaint as valid, that could also inevitably delay the whole procedure.
So do we know the timeline for a likely ruling, given that investigators are also separately trying to figure out how to arrest him?
The Constitutional Court has up to 6 months to review and deliver a ruling. But if you look at the past cases, it took about 2 to 3 months for the court to review the impeachment and deliver a decision. In 2004, the court reinstated then President Roh Moo-hyun, saying that his wrongdoing at that time, it was an election law violation. It was not serious enough to kick him out of the office. Then in 2017, the court unanimously decided to remove then President Park Geun-hye from office in an influence peddling scandal after a 3-month review. Now, the court has 6 months, but 2 of its 8 justices are set to retire in April. So it's widely expected that the court may want to deliver a ruling before then, because they need at least 6 justices to agree on removing Yoon from office.
Soo-hyang, it's been over a month since the martial law decree, and of course we're together on the ground in Seoul covering that. I remember what was interesting was that the majority of the public in Korea really wanted to see Yoon impeached. They were not in agreement with the martial law declaration, but also there were a few people who would gather continuously in Gwanghwamun, really supporting the president. What's public sentiment like now?
Right, the public sentiment has quite shifted. Interesting is that we've seen the support rating for the main opposition, Democratic Party, sliding as much as 12 percentage points in our latest poll, and that compares with how the ruling conservative People Power Party's support rate has been increasing to a level above what was reported before the martial law. Now, remember, the opposition leader Lee Jae-myung is one of the more polarizing figures in South Korea's political landscape who faces his own trial. So what we can tell from these polls at least is that even if the court rules in favor of Yoon's impeachment, and which would trigger an early election within 60 days, that does not necessarily mean that the Lee or the Democratic Party will gain an easy, clean victory. So we'll have to watch the developments very closely.
Bloomberg's economy and government reporter Soo Hyun-chae there with the latest. Coming up on the Asia Trade, our exclusive interview with the UBS Global Head of Economics and Strategy Research is next. Live from their Greater China Conference, we'll be talking about Asia's developing economies too, with the co-winner of the 2024 Nobel Prize for Economics. We'll also be heading to the Goldman Sachs Global Macro Conference in Hong Kong today to speak with their chief economist. Much more ahead. This is Bloomberg. Let's take a look at how we're trading. We're just about 15 minutes into the start of the cash session. A little bit of upside, actually, after what has been really a dour few sessions here in Australia. The ASX 200 up by just about 0.5% there. So really kind of following on the back of the dip buying, I should say, wave that we saw in the previous session on Wall Street. Well, the UBS Greater China Conference is continuing today in Shanghai, and there is our Chief North Asia correspondent, Steve Engel, with our next guest. Steve.
Yeah, that's right. The coffee is starting to percolate and the people are starting to trickle in, obviously, on day two, the last day, actually, of the UBS 25th anniversary Greater China Conference here in the financial center of Shanghai. And our first guest this morning is Arend Kapteyn. He is the Global Head of Economics and Strategy Research at UBS, also the UBS Chief Global Economist. Great way to start the morning because, again, we've seen that jobs report from the United States on Friday, followed by a sell-off globally yesterday, a little bit of a recovery in the S&P overnight. But again, it's about the bond treasuries, essentially, you know, the sell-off and the yield spiking. We could get the trifecta soon with the 10-year going to 5%, 4.8 right now, after the 20 and 30 already surpassing 5. How do you read this and what it means about the state of the U.S. economy and going forward?
Yeah, so I think it's a combination of three things, what's happening in the bond market. So supply has not actually gone up, right? So, but I think the fear of supply sort of plays a role. So what's actually going to happen on the fiscal, we don't really know. I think there's a tariff fear, right? Again, we don't really know. So it's very, very difficult for people to buy the bond market here at these levels when you've effectively got career risk when you don't know what's going to happen in the next 100 days. So I think that really keeps people at bay. And then I think the jobs report and just the optimism about sort of, you know, the continued strong growth in the U.S. sort of managing to sustain itself, I think, is sort of the third factor. Now, we don't really believe any of that, so we feel this is an overshoot. If you look at the term premium move that we're seeing, we've only seen a move like this sustained in 2008 and 2013, the taper tantrum, right? We had something similar in 21 and 23, and it didn't last. So looks like an overshoot, but it feels a little too early to buy.
Well, people are just kind of going, wait and see what's going to happen. And not just from 6 days or 7 days from now from the inauguration. What are going to be the policy steps? Day one could be a lengthened out process.
It could be a 3-month process where we have to wait to see what gets announced.
Right. So how sticky is inflation, and what does that mean for rates going forward?
So it's not, in the components that we think really matter, it's not, it looks like the stickiness is sort of disappearing. If you look at sort of the way rents are behaving, that's now finally moving in the right direction. I think the problem in Q4 is you have a sort of a pandemic residual seasonality problem where if you use pre-pandemic seasonals, then, you know, I think the inflation data would have looked a lot better. So we knew there was going to be some, you know, some stickiness or some elevated prints the last couple of months. We actually have sort of a pretty hot one penciled in for this week and then another one for January, but then it starts to sort of come down. So we're not actually very concerned. The other thing I'd say is when you look globally, the data looks fantastic, right? So the disinflation momentum's actually picked up. So it really feels like a bit of a disconnect here between what's happening in the U.S. bond market and what we're actually seeing in the data.
Is there an argument to be made that there won't be any cuts this year, or maybe one?
You could get there in two different ways. We have 4 cuts, right? So we don't. So I think the way you would have to get there. So ultimately we think the Fed follows their models, right? And their models, if you pencil in a slowdown to something like 2%, which is what the Fed itself has, and you pencil in some additional disinflation, the models would say you got to go to a low 3% Fed funds rate, right? Not 4 or not above 4. But it's highly sensitive to the data. So if you don't get a slowdown, right? If the top 20% keeps carrying the economy and inflation stays at these levels, then you can start to justify the market pricing.
Right.
Now, if you then also get tariffs on top of that, then you can even start to think about, well, do they maybe have to reverse some of these?
Well, how inflationary are tariffs going to be? You spoke to Randall Quarles yesterday, the former Fed Vice Chair of Supervision. I had him on TV yesterday as well, and he said basically tariffs are not inflationary. Maybe that's a Republican mantra right now that they truly believe. But in your year-end report, you said we don't see tariff risk being priced in global currencies. Does that mean there's no threat, or that means it's just not priced in yet?
So we don't think they're priced, right? And I think the notion that they're not inflationary comes from the 1819 experience. But of course, the problem is that what happened then was about 1/5 the size of what Trump has campaigned on, and actually what he campaigned on was only China and then this global tariff, not the 25% in Canada, Mexico, et cetera. And so the ability of the corporate sector to absorb these tariffs like they did in his last term is just not going to be there. And so we do think it's inflationary. Now, I think then, of course, it becomes an issue of, well, tariffs on who and how high are they, and what do you exempt? Because the way we think about the tariff impact for, say, a China tariff is if you exempt the goods where China is dominant, so in our forecast, we exclude 25% of all the goods where you have no ability to buy anything else, that greatly lowers the inflation impact, right? So if you do across-the-board tariffs, it's much more inflationary than if you start to exempt the things where you have no alternative.
Well, I read a Bloomberg story today saying that they're thinking about the possibility of extending those, amortize it out over many, many months. 2% one month, 2% another month. What kind of inflationary impact as far as steady inflation would that cause?
So I think that's problematic for the Fed, right? So I think normally we think of tariffs as a one-off price level shift, and then it goes away a year later. And then provided it's not big enough, you don't have spillover effects. So you don't get second round effects that sort of are inflationary. But if you do rolling tariffs, it's a little bit like the repeat of the pandemic and the Ukraine shock that we had. You have one supply shock after the other, and you start to create sort of a much higher peak in inflation. So I think it would be much more difficult to sort of know what to do with that as a central bank.
We're going to have Wong Tao on a little bit later on at 8:30 Shanghai time to talk about the China market. But what do you see as the real shock that's going to be on the Chinese market on these tariffs?
So I think we have an existing property problem, which is well known, right? So we have an economy that's already struggling, and we think even this year is still going to the property market subtract about 2 percentage points from growth. The tariffs, we think, on our level of tariffs will subtract another 1.5, right? And I think the policy responses are quite different to both of those shocks. How the market react, I think, is a bit unclear, because if you think of what is the market? I mean, if it's the equity market, a lot of what's tradable, so if you think about sort of H shares, for instance, it's internet and consumer companies. They're not, a lot of those are not necessarily going to be subject to the tariffs. And then the question is, well, what is the knock-on effect from the weakness in the economy to those companies? And so, sort of somewhat strangely, perhaps, or perversely, we actually, one of our favorite markets this year is the Chinese equity market, despite the fact that we have a very, very bearish forecast on the economy.
Well, so in your year-end report, you said growth to slow, global growth over the next 2 years to 3.2% from 2.6%. Is there any upside?
Sorry, so it's going from 3.2 to 2.9. Yeah.
2.9 next year, but 2.6 in the next...
In 2026, correct.
In 2 years, right.
Yeah.
So any upside surprises that we could...
No, I think there are many, right? There's so much policy uncertainty. There's many things that could go right? I think we could see the Chinese property market recover more quickly than we think. We could see more stimulus. We could see lower tariffs. We could see... there's a whole range of things that I think could go right, but at this stage... we're more on the worrying side in terms of what's coming our way.
Arend, thanks for kicking off this morning coverage this morning and having us here at the UBS Greater China Conference. Thanks so much. All right, Shery, going to send it back to you as we've kicked off day 2 of the UBS GCC. Back to you.
Yeah, Stephen Engel there in Shanghai with great conversations coming up today from that conference for the remaining of today's session. And still to come, millions of residents on edge with the Southern California wildfire threat set to intensify. The latest live from Los Angeles next. This is Bloomberg.
I implore everyone to not disable the messages on your phone. This is extremely frustrating, painful, and scary, but these alert tools have saved lives during this emergency.
Residents in Southern California are being asked to stay alert as the region braces for a second week of fierce winds whipping up wildfires that have already killed at least 24 people. California Governor Gavin Newsom is proposing the state provide at least $2.5 billion in additional funding for emergency response efforts to fires in Los Angeles. Let's bring in Bloomberg's clean tech reporter Michelle Ma. Michelle, so what's the latest on these containment efforts and how much would this extra funding help?
Well, so containment efforts, are progressing, and we're making progress for sure. From times last week when the fire was still 0% contained, we're definitely improving. But I think the concern right now from a lot of folks on the ground is that we're going to see continued high winds Tuesday and Wednesday, and I think there's a lot of concern that those high winds, accompanied by the dryness of the condition, is going to make the fire worse and dampen containment efforts.
What do we see when it comes to conversations around rebuilding and, I guess, preparedness for future? I say fire seasons, but of course the concern is that this shouldn't be peak fire season, that it's kind of going to be the rolling risk going forward as the climate changes.
That is a very real concern, and I'm really glad you brought that up. No, this is not going to be the last time that California sees wildfires like this because of climate change, like you mentioned. And, I've been talking to community members on the ground throughout Los Angeles this week and last week, folks in Altadena, folks in the Palisades who have been affected by these fires, who have lost everything. And, I think that the conversation around rebuilding right now is, for some, too soon. For others, that's the only thing that's on their mind. And for everyone, I think it's an open question, right? Like whether or not they'll be able to rebuild, even if they want to, if their insurance companies will be able to support them the way that they want to. They're already starting the claims process, trying to get on the phones with their insurance companies, all the while trying to secure more permanent housing, more rentals, navigating all of the logistics that are involved in dealing with the aftermath of losing everything. So it's really a lot for everyone in Los Angeles right now. Everyone's affected.
Yeah, completely overwhelming, even as we start to see sort of a little bit more improvement on the outlook. But that was Bloomberg's clean tech reporter Michelle Ma joining us. And of course, there's more on the global fire threat and climate threat ahead. We take a look at how Australia is dealing with its bushfire season, especially with these overlapping global fire risks. The ANU Institute for Climate, Energy and Disaster Solutions will be with us on Australia Ahead. This is Bloomberg. All right, take a look at some of the data that's just crossing the Bloomberg when it comes to Westpac consumer confidence numbers for the month of January for Australia. Confidence falling 0.7% month on month. The confidence number is falling to 92.1. We have seen, of course, just increasing concerns when it comes to the level of retail confidence here in Australia, household confidence, particularly with the retail sales numbers coming in quite weak, even for that peak November-December period most recently. So that cost of living crisis, high interest rates and uncertainty over when the RBA will actually start to cut is still very much playing out there. When it comes to the Aussie dollar, as you've seen, just said before, we have seen a bit of a move when it comes to the Aussie as well as the Kiwi in this part of the world, really leading the charge in reaction to the reports of perhaps more moderate, gradual moves, Shery, when it comes to these tariff strategies from the incoming Trump administration.
Yeah, at a time when we continue to see dollar strength, we have Goldman Sachs also lowering the forecast for the Aussie dollar to 62 US cents in 3 months' time. Take a look at where we're at when it comes to the stock market. The ASX 200 gaining about 0.5% as we continue to watch Nikkei futures at the moment, upside of 0.9%. Japan coming back from holidays, the Nikkei was down for 3 sessions. The Japanese yen little changed during that time over the long weekend. We are awaiting the Deputy Governor of the BOJ, Himino, to speak this morning, and that will give us sort of an indication of where the BOJ goes from here. U.S. futures at the moment pointing to the upside. We had seen a little bit of rebound on the overnight session, given some dip buying that we saw that reversed S&P 500's losses of almost 1% in the session, Haidi.
And of course, in addition to the move that we see in currencies, also watching treasuries as well, as we see kind of not just stocks wiping out, being close to wiping out that Trump bump, but also these Fed rate cut hopes continue to dim. Although, of course, we just had a previous guest still pricing in 4 cuts from the Fed this year. So clearly there's a lot of uncertainty on either side of that bet there. That's what the US 10-year yield is doing at the moment. But let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. And of course, so much of the sort of dimming of Fed easing hopes has been linked with the fear of surging inflation from tariffs. So this news potentially of a more moderated, piecemeal or at least sort of, flexible approach month by month, does that give a little bit more, positivity to investors?
I'm really not sure that it does. Apart from anything else, we had a similar report a while back that gradual tariffs were being considered. And within hours, Trump was out on social media saying, no, it's not being considered. And what he has said publicly about tariffs is very much on the shock and awe side of things. He has publicly stated numerous times that tariffs are beautiful, that they will make America great again. So I think you have to regard such reports with a healthy dose of skepticism. Not that it isn't the case that there could be people within the Trump administration or within those circles who are looking at ways they could make this approach less of a disruptor for the US economy, although the aim is, after all, to disrupt the global economy. But that doesn't mean that those proposals will make it onto Trump's table, and if they do, that he will accept them. As far as yields go, tariffs are only one of the reasons why yields have been climbing. Another reason is Trump is definitely going to move to retain the tax cuts he brought through in 2017 and look to add more tax cuts to it. There is on his agenda the idea of cutting waste from the US government. But we've had plenty of experience with both sides of American politics, promising big spending, but fixes which will meet the spending doesn't have to be funded by bigger deficits. We haven't seen those not so big deficit part of it coming through. So that's a big part of the concern as well. There's also the concern that I think you had a previous guest talking about, if you've got tariffs being imposed at a low level, but then each month they're going to go up, that would actually threaten to sort of lock in a higher path for a gradual higher path for prices. And in fact, in some ways, a better look for the economy is if you have a one-off tariff shock and then the economy can adapt to it, rather than setting in motion a process where each month you see higher tariffs. So there's a lot to digest there. I think part of what's going on today just shows how much fear there is of what tariffs could do.
Yeah, and also, of course, we know that a big target is Beijing at the moment. And with a trade surplus at record highs, of course, that's really going to get the ire of Donald Trump. Not surprising, all of these expectations for Chinese assets have been going downwards, but at the same time, Beijing really not sitting still. They continue to pledge more support.
Yeah, that is a constant. The problem is that apart from last September's big announcements that they would definitively moved to stimulate. They changed some of the language, both that the government was using and then that the PBOC is using. But they've also made it clear that they're in charge of a super tanker. They're not in the business of doing U-turns. They will take a gradual course to try and turn the economy around. It's not at all clear that they will be able to turn the economy around sustainably. And also, if they do turn it around, does that end up being still a slower, lower growth profile than many had been expected? I think a lot of investors are coming to the judgment that China is not going to go back to being the hugely impressive leader of global growth that it was for much of the 2000s up until now. So in that context, a lot of people are lowering their sights and probably hoping for a slow, gradual recovery in Chinese assets. The difficulty is that right now there still remains so many headwinds. Perhaps the best that can be done is to prevent serious declines from here, at least in the short to medium term.
Garfield Reynolds, who leads the Markets Live Asia coverage, there with us. Now, the latest from the corporate front, Apple's iPhone sales fell about 5% globally in the final quarter of 2024, hurt by underwhelming upgrades and competitors making inroads in China. Counterpoint Research says Apple's global market share slipped 1 point last year to 18%. Separate IDC data offers a similar picture, giving Chinese smartphone brands their best combined quarter on record, taking 56% of global sales. Bloomberg has learned that Honeywell International is poised to proceed with a breakup after pressure from activist investor Elliott Management. Sources say it's planning 2 publicly traded companies, with one focused on automation and the other on aerospace and defense. We're told it may announce the plan with its fourth quarter earnings in February. Bloomberg's been told Cleveland Cliffs and Nucor are looking at a joint offer for U.S. Steel. The Cliffs CEO confirmed his interest at a media event and later told Bloomberg he'd fund the deal using debt. A source says the partnership could include Cliffs acquiring most of U.S. Steel, while Nucor took its mini mill assets. Shares of all 3 companies jumped on the news. Sonos CEO Patrick Spence is leaving the company after a failed app revamp upset customers and stunted growth. The audio technology company named Tom Conrad as interim chief executive while it looks for a new leader. Sonos launched a new mobile app last May that came riddled with bugs. Spence was criticized for not apologizing fast enough, while Sonos had to delay multiple product launches.
Well, still to come, Shery will be back at the UBS Greater China Conference with the co-winner of the 2024 Nobel Economics Prize. That exclusive conversation is next. This is Bloomberg.
Kamala and I took office, our nation had become stronger at home, are stronger in the world. And now, America is more capable and I would argue better prepared than we've been in a long, long time.
President Biden arguing that his actions over the last 4 years have left the US in a stronger position ahead of the inauguration of Donald Trump. Some of the other stories that we're following this hour, and President Biden says negotiators are pressing hard and on the brink of a deal to pause Israel's 15-month war in Gaza. Earlier, Israeli officials said they'd presented a detailed outline to Hamas during indirect talks in Doha. Sources say the first phase would involve a 42-day ceasefire and the release of 33 Israeli hostages in exchange for Palestinian prisoners. Members of President-elect Donald Trump's incoming economic team are said to be discussing slowly ramping up tariffs month by month. Sources say the gradual approach is aimed at boosting negotiating strength while helping avoid a spike in inflation. We're told the proposal is in its early stages and has not been presented to Trump. Greenland's Prime Minister reportedly says he wants closer ties with the US, highlighting the Arctic island's push for independence. His comments to a local broadcaster come after Donald Trump repeatedly restated his ambition to take control of the self-ruling territory of Denmark that's home to 57,000 people. House Republicans have introduced a bill to begin negotiations called the Make Greenland Great Again Act. Well, the second day of the UBS Greater China Conference is getting into full swing in Shanghai. Let's get back there. Our Chief North Asia correspondent, Stephen Engel, is with our next special guest. Steve.
Yeah, that's right. Day 2 of the 25th anniversary of the Greater China Conference here in Shanghai with the UBS, obviously. And our guest now is James A. Robinson, Professor James A. Robinson at the University of Chicago, and he's an economist and political scientist and the 2024 co-winner of the Economics Nobel Prize. Thanks so much. It's not often we get the honor to speak to Nobel laureates as yourself. So you're here at the UBS conference. I'm sure you're going to be peppered with a lot of questions. You're going to be on stage. What's your main message to the banking community here, 3,000 of which are attending this record attendance?
Well, I think you know, the people at this conference, they're very interested in understanding, you know, where is the world going and what's happening with economic growth in different parts of the world, and, you know, and what does the future look like, and who's going to do well and who's not going to do well. And my message is that's all about institutions. You have to look at the institutions. That's what my research shows, and try to understand, you know, what do the institutions imply for people's incentives and opportunities and prosperity?
A lot of your research really looked into the discrepancies between nations and why some succeed and why some fail, and why those patterns perpetuate. Obviously, we have the two global superpowers, the United States and China, economic superpowers, but from very different models. How do you draw, what conclusions do you draw from the United States model, which has a long-term success, and the Chinese model, which has really only been the last couple of decades in this current iteration?
Yeah, differences and similarities. You know, I would say what's similar is, you know, fundamentally the United States has flourished because it has what we have inclusive economic institutions. It has rules that create broad-based patterns of incentives and opportunities. And, you know, in some sense, that's exactly what China didn't have before 1978, and that's exactly what it created after 1978. You know, it abandoned the socialist economy. It created, the state withdrew from, you know, the economy. It created opportunities for entrepreneurship. It created incentives. The private sector flourished, you know. So that, it's sort of moved to this much more inclusive economy, and that's what's driven economic prosperity. So that's something we understand, you know. So what's more complicated from my perspective is, you know, I'd say, why has the United States been able to sustain that sort of economy? That's to do with the political institutions, and of course China has very different type of political institutions, so that's the bit that fits less well.
So how does the current iteration of the Chinese economy, which cracked down on innovation, de facto innovation, by cracking down on the platform economy like Alibaba and the like, and the job creation that created and the innovation that it created? Is it a political model that perhaps is not suited for that long-term creative destruction that you talk about in your research?
I think that, yeah, I mean, I think that's right. You know, I think there's no historical precedent for a country becoming, you know, like a first world country with a political system what like China has. I mean, of course, there's Qatar or whatever sitting on oil and natural gas, but apart from that, you know, there's no, based on industry and education, and there's no precedent, historical precedent for that. So I think, you know, what's paradoxical is that some things do flourish. You know, electric car is flourishing, for example. There's a lot of innovation and entrepreneurship. So some things flourish, other things don't flourish, but I think the big picture would be, yes, it's very hard to have an inclusive, innovative, entrepreneurial economy when you have this kind of power structure in society.
Can China break the pattern, though, of failed countries that, you know, have moments of prosperity, but because you mentioned in your research as well about the Soviet Union, where they essentially flourished as a main superpower until they hit the 1970s, and then they hit that roadblock of no creative destruction, where you need innovation to continually replace outdated technologies. China could possibly break that model because you mentioned EVs. They're an innovative society as well, and they have deep pockets.
Yeah. Yeah, I mean, there's a history here of entrepreneurship and trade and innovation, which you didn't have, for example, in Russia. So there's something culturally different about China, which is fascinating. I mean, in Why Nations Fail, what we point out is there's many examples in world history of societies that have these awkward combinations of institutions that can prosper for 40 years, 50 years. I mean, Argentina was one of the 10 richest countries in the world in 1910. But, it was in the right place at the right time, but it never had the institutions to really go to the next stage. So I think the way you articulated that is exactly right. That's the problem in China. Do they hit the wall like the Soviet Union, or can they do something different?
How do you factor in the next technological leap that we're experiencing right now, and that is AI, which is being developed sort of in a bifurcated world because of trade disputes and national security concerns?
Well, that's a fascinating topic. What's interesting in China is the enormous amount of effort being put into AI. But AI is seen as much as a tool for managing society as it is for something for raising human productivity. So the question is, are those two things compatible, or are they not compatible? Can I innovate something which allows me to control people but simultaneously raises productivity? And I guess my view would be the answer, there's a lot of research on that at the moment by academic economists. But my view would be you can't combine those two things.
So the creative destruction concept is happening in the United States. We're seeing the automobile industry being replaced by EVs. Disruption is happening.
Absolutely.
AI, they're saying, is the absolute next industrial revolution that is happening. In China, I think data security has become a big issue. Because companies like Alibaba, as I mentioned, grew their data resources exponentially and was not able to control it by the government. Would you agree that is perhaps going to keep that bifurcated world of AI development could actually be very separate paths?
Yeah, AI can be pushed in lots of different directions. It's not something that's just inevitably goes in one way or another way. I think one of the big debates at the moment is AI going to be something which raises people's productivity or replaces people with robots? I'm trying to use AI to make myself more productive, not to replace myself, But a lot of the model is, we're just going to get rid of workers. We'll push wages down, we'll reduce the wage bill, we'll make more profits. But that's a model with enormous social consequences.
But do you buy into Elon Musk's vision of the future?
What's that?
We're going to go to Mars. We're going to have a home robot. Everything. We're going to have small government.
I think that libertarian model of the future is ludicrous, actually. I think all the evidence is, the role of the government in the United States is absolutely crucial. Who invented the internet, for heaven's sake? Not Elon Musk, know. So I think we need the government to counteract, the worst effects of capitalism. So I'm very much a believer in that model, and I think that there's this kind of race, between the state and capitalism to kind of control it. Think of all the investment in education and security and public goods, and who is it that's creating this labor force and this kind of environment? I've worked a lot. I was in Somalia last year. Now, there's a libertarian paradise for you. No government, no taxes, no regulation. It's not a rich, successful country.
Yeah, that's sustained as well. All right, James A. Robinson, professor, Nobel laureate in 2024 for economics. Thanks so much. We should go much longer next time. Thanks so much. And Haidi, we'll send it back to you guys.
I'll take it over, Steve. Our Chief North Asia correspondent, Stephen Engel, of course, there with the conversations coming from that UBS conference in Shanghai. We do have breaking news at the moment out of Japan. We are getting the trade surplus, the current account surplus, coming in for the month of November. And for Japan is 3.353 trillion yen, which is surprising to the upside. Adjusted current account surplus also at 3.03 trillion yen. This would leave the current account adjusted surplus at a growth of more than 50% year on year for the month of November. We've seen slight improvements in the current account numbers for Japan in the past couple of months, and again for the month of November, surprising to the upside. We'll be looking forward to the market opens in Japan in about 8 minutes after the long weekend. This is Bloomberg. Japanese drug maker Takeda Pharmaceutical says business in China is growing fast, but CEO Christophe Weber told us that growing geopolitical risks have deterred the company from expanding there more aggressively.
Well, we'll see what happens. I hope that healthcare or pharmaceutical will remain protected from geopolitical tension or tariff, because innovation in healthcare, in pharma, come from many different countries, many different biotech. So if you start to have geopolitical tension or tariff or no access, it means that some medicines won't have access and patients will suffer. So my plea is that pharmaceutical healthcare should stay away from any geopolitical tension or tariff.
Well, we should find out soon enough there.
See.
And I have about time for one question left with you. And I want to talk about what you're doing in China, because you've been aggressively partnering with Chinese biotech companies. And you think about the U.S. and the Chinese relationship, a lot of concern, a lot of questions over what that will look like under the second Trump administration. Could that give you any pause when it comes to that strategy?
So there is more innovation in China. It's still limited compared to the US, and we should actually remember that 80% of the new medicines in the world come from the US, so this is something very important. We are growing very fast in China, but because of the geopolitical risk, we have been very careful not to have any dependency on China. So in case there is a bigger tension, we will not be impacted. So that has been our strategy.
Takeda Pharmaceutical CEO Christophe Weber there speaking to us earlier. Well, the market opens are almost upon us in Seoul and Tokyo in the next few minutes. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. Haidi, we continue to watch whether that global bond route will continue to the Asian session. Of course, we had Treasury yields continuing to rise, despite the fact that stocks did rebound on the Wall Street session. What that means for currencies across Asia is a big question, as the dollar now continues to gain ground for 5 sessions already.
Yeah, what's also interesting, we are seeing that sort of market reaction to this report that we could maybe see a staggered, more moderate, or at least a monthly approach to implementing tariffs. Of course, nothing's been confirmed. We know that sort of this has been floated before when President-elect Trump has actually come out and refuted this. So there's absolutely no certainty. But certainly if that was the case, perhaps we could see a little bit more calm when it comes to these markets.
Yeah, especially if we see more downside on the U.S. dollar, right? But right now, what we're watching very closely also central bank action, because we are watching the BOJ Deputy Governor Himino speaking later today, and that will determine perhaps where the Japanese yen and yields could go from here, because that will give us an indication of where the BOJ goes from here. And we have seen the Japanese yen little changed ahead of that speech and press conference. But we're watching the 10-year yield very closely, because we're already at around levels that we haven't seen since 2011. Will we continue to get more upside as we see the global bond sell-off is a key question, as we are also keeping an eye on the 40-year yield, because it's very close to record highs at the moment. And of course, we are seeing markets coming back from that long holiday weekend for Japan, and we're seeing downside for the Nikkei of 0.7%, a little bit of a catch down perhaps, given that we had seen that sell-off broadly in Asian markets on the Monday session. But take a look at how Korea is coming online as well, as investors digest a lot of economic news. We just got the trade surplus coming in from Japan, the current account surplus widening as well. The Kospi now gaining about 0.5% at the moment, as we also continue to watch political risk because the Constitutional Court now begins trial on whether to uphold the removal of President Yoon Suk-yeol in South Korea. A little bit of upside for the South Korean won. We're seeing support, Haidi, as we have seen more PBOC warnings and interventions in order to support the offshore yuan as well.
Yeah, just that sort of at least meaningful rhetoric when it comes to the stabilisation of the market more broadly. Does that lend support to some of these sort of China proxy assets like the Aussie dollar? This is a picture when it comes to Australian assets. We have seen a little bit of upside when it comes to trading in Australian stocks, at least, after quite a bit of malaise over the past couple of sessions. We're seeing, in particular, that reaction across miners, financials and other related stocks. They're seeing a bit of dip buying, perhaps, after the recent days of sell-off. But when it comes to households, the outlook is still pretty gloomy when it comes to the consumer sentiment numbers that we saw falling 0.7% in January. So that is really being reflected by just the sort of structural weakness in the Aussie dollar. It is a little bit higher today, but we're off about 8% against the US dollar over the past 3 months. And as Shery mentioned, we're clearly following what's going on with yields at the moment, with this sell-off continuing to ripple through global bond markets.
Yeah, so what a perfect time to really head to the Goldman Sachs annual Global Macro Conference for Asia Pacific, getting underway in Hong Kong right now with more than 2,000 investors, policymakers and analysts gathering to really go over the economic outlook for the year ahead. Our China correspondent Min Lo is there with our next guest. Min.
Thanks, Haidi. Certainly what those Trump tariffs mean for the global economy is an important theme here at the Global Macro Conference. And the perfect guest to join us here discussing this is Hatzius, the Chief Global Economist at Goldman Sachs. So, Jan, really great to have you here. And I want to start with what's happening in the U.S. because obviously we're waiting for the inflation data. We had a very strong jobs report on Friday, and we're seeing yields spiking. Investors really stop pricing in anything more than a full rate cut. But your house view, though, is still that the Fed will cut twice this year. Why is that?
Basically because we think that inflation is still on a normalizing path. And right now we're at 2.8% for the core PCE measure that the Fed watches particularly closely. We think that's going to go down to about 2.4% by the end of the year. And even of that 2.4%, about 30 basis points in our forecast comes from tariffs. Tariffs are more of a one-off effect. It's a price level effect. So you might want to sort of downweight that 30 basis points. And the underlying inflation rate in our forecast is 2.1%, which is very close to the Fed's target. So in that kind of environment, I still think you're likely to get a couple of cuts. But clearly the FOMC is in no hurry. And therefore, we think it's probably going to take until later in Q2, maybe the June meeting, for the first cut to be delivered.
As you said, inflation is actually still quite well above that 2% target. Do you see any risk of no cuts at all, and under what scenario?
I think you can't. Look, there's always a range of scenarios, so it's hard to really rule anything out, especially when it comes to monetary policy. Monetary policy has to be very data dependent and respond to new information. So if we were to see very sticky inflation closer to 3% throughout the year, yes, I think in that case they might not cut. That's a possibility. But again, if I look at the adjustment that's occurring in the economy, the trends in the most kind of least noisy components of inflation, if I look at the labor market rebalancing that we're seeing even after the strong jobs report and the slowdown in wage growth, to me that suggests there's still some room for monetary policy to normalize. After all, the funds rate's still quite high at 4.25% to 4.5%.
Okay, so you see the Fed cutting as a way to normalize rates. But meantime, we actually have the news today that Trump's economic team is looking at possibly a gradual approach to those tariffs, hiking maybe 2 to 5% per month. And to me, this sounds like it's just going to be a giant headache for businesses. So what is your take on this and how it's going to shape global trade and businesses?
First of all, I'd say there have been a lot of different reports about tariffs. I mean, I think we can have pretty high confidence that tariffs are coming in some form. What form exactly they take, I think, is still a little bit open to debate. There is a there are different approaches to rolling out tariffs. You could do a 10% tariff immediately, or maybe a 20% tariff on China. That's our baseline assumption. But you could also roll this out more gradually. I think which one is more damaging or less damaging is a little bit of a judgment call, because if you go more gradually, then obviously each increment is pretty small. It's kind of predictable what happens next, but it also lasts for a longer period of time, and you don't get it over with in some sense as quickly. So I think those are ultimately probably a little bit more details. The important point is that, yes, I think tariffs on China and probably on auto imports from Europe are probably coming. That is part of our baseline, and that is going to have an impact on inflation and on growth. Not a huge impact. These kinds of tariffs that we have in our baseline, they don't negate that we still have a pretty constructive inflation outlook and an above consensus growth outlook. We're at 2.5% GDP growth for 2025, which is still about half a percentage point above the consensus.
Okay, and I want to talk about China here, because your house view is that we could see the CSI 300 gain some 20% by the end of the year, which I think is one of the most optimistic ones out there at a time when investors are pulling out of China. And in fact, you're thinking that the CSI 300 will outperform the S&P because your outlook there is an 11% gain by the end of the year. What is underpinning this very strong outlook on Chinese equities?
It's really more a view on, valuation and the fact that quite a lot of bad news is already priced in China, whereas a lot of good news is priced in the US. From an economic perspective, we're above consensus for the US, as I just noted, and we're more in line with consensus on China, 4.5% growth. We do think there's going to be an impact from the tariffs that we just discussed, although I think a significant part of that is going to be undone or cushioned by policy stimulus. But from an economic perspective, our forecast is deceleration from 4.9% last year to 4.5% now. But that's not the only driver of equity market and financial market performance, because the initial conditions and what investors are already discounting also plays a role.
Right. What is your expectations of the sort of stimulus we could see from China?
We think it's going to be a broad range of measures, rolling out additional monetary easing, fiscal easing, and support for the housing market. I'd also note that if you look at the housing markets, obviously a very big downturn that we've been seeing unfold over the last few years, that is still ongoing. But in certain regions, at least, we are seeing some more positive developments on home sales. I think housing will continue to be a headwind in a bigger picture sense over the next several years. But at the margin, in the higher frequency data, we are getting a little bit of support, suggesting that the policy easing is having some effect.
Okay, I want to touch on India, because India had been that bright spot last year and gaining importance as concerns mount around China. But we do see India sort of paring back expectations of growth. We've seen a market sell-off recently, the currency plunging. Are you still optimistic on the India story?
Well, I think what we've seen in India has been above trend growth, and growth really at an unsustainable pace. We think that the potential growth rate of the Indian economy is closer to 6%, and we've been running well above that. So that transition from an above trend pace to more of a trend pace, that was always going to occur. And of course, these transitions can be, a little bit disruptive, and investors, maybe disappointed as growth slows down. But in my view, it's really an inevitable deceleration, which we're going through now. But if I look at the longer term outlook, something in the 6+ range, I think is very realistic for India for many years. And that's a very rapid potential growth rate, even if it's not quite as rapid as the numbers we've been printing in the recent past.
All right, thank you so much, Jan. That was Jan Hatzius, Chief Global Economist at Goldman Sachs. Haidi.
China correspondent Min Lo at the Goldman Sachs Global Macro Conference for Asia Pacific in Hong Kong, and some of these geopolitical tensions when it comes to tech between the US and China are front and centre as we count down to the inauguration of President Trump. We do have some breaking news just crossing the Bloomberg when it comes to a Bloomberg scoop. Chinese officials are said to be evaluating a potential option that involves Elon Musk potentially acquiring the US operations of TikTok if the company fails to fend off a ban on its app. This is according to people familiar with the matter. Beijing officials strongly prefer, of course, that TikTok remains under the ownership of ByteDance, the parent company. The company is contesting that impending ban, of course, with an appeal to the US Supreme Court. But in those arguments that we heard on January 10th, the justices did signal that they're likely to uphold that ban. And we have heard that Chinese officials had already begun debating kind of contingency and plan Bs for TikTok as part of this expansive discussion on how it would operate and work with the incoming Trump administration. One of those scenarios we understand involves this potential option for Elon Musk to acquire TikTok's US operations. So in a sense, this offers some appeal for the Chinese government, which is expected to have some say over how this is eventually resolved. Musk has spent more than $250 million supporting that Trump re-election campaign, and of course is tapped for a prominent role within that space in terms of government efficiency. More ahead on that story as we get the details, and more ahead here on the Asia Trade. This is Bloomberg.
Bloomberg has learned that Chinese officials are evaluating an option that involves Elon Musk acquiring the U.S. operations of TikTok. For more, let's bring in our tech reporter Annabelle Jewelers-Rembel. Of course, TikTok facing a potential ban in just less than a week, actually. What are we hearing from sources?
Yeah, well, it's sort of difficult to understand what's on people's bingo cards for 2025, but this is something certainly that's going to be capturing a lot of attention today, I'm sure. But what we're hearing from sources is that Elon Musk could be emerging as perhaps a buyer for TikTok's operations in the US, or that's at least what the Chinese government right now could be thinking as a potential option. As you said, we had the hearings from the Supreme Court last Friday, and very much the indication out of that is that TikTok's going to be forced to go so-called dark on January 19 or after January 19, unless, of course, it divests its US operations. Going dark means that people won't be able to access it on the US App Store, and that they also TikTok users won't continue to receive any sort of updates. But this is a potential deal that possibly does hold some appeal for the Chinese government, which does, of course, have say over whether TikTok is ultimately sold. That is one scenario that we're hearing about. The deal value of this, Bloomberg Intelligence, again, it's very difficult to say, but last year they were saying TikTok's US operations could be worth something to the magnitude of $40 to $50 billion. And it's also not sure what sort of structure the deal could take either, but it would certainly be a very complex process.
The spin-off of just the US business, how complex will that be? Because, lawyers have talked about how extraordinarily difficult this would be.
Yeah, that's right. We were talking about that as well yesterday, that TikTok, for its part, is saying, and they said this on Friday as well, that they've got people working at the company in the US, in China, across Europe, and they're all working off the same source code. They're all using the same sort of content. But the response from ByteDance, what we're hearing as well from our sources, that maybe they're actually not so involved in these discussions from the Beijing government right now. We didn't actually get any response from ByteDance or TikTok's representatives, but certainly the talks in Beijing as well that we're hearing again from this scoop suggest that TikTok's fate isn't necessarily in ByteDance's sole control either, because the Chinese government has a so-called golden share in the ByteDance affiliate that does give it influence over the company's strategy and its operations. And even though TikTok maintains that the control only applies to its Chinese operations, Beijing still does have export rules that prevent Chinese companies from selling their software algorithms. So again, they do have a say in how ultimately this plays out.
And what's interesting, Belle, is that now we're seeing some of these so-called TikTok refugees, basically TikTok users migrating to another Chinese social media app.
Yeah, this is one of the probably the second order effects that certainly US officials might not have anticipated, because for so long now we've been thinking about, okay, who are the potential winners out of this? And always Instagram and Meta's companies come to mind. But actually what we're seeing in the last couple of days are the trends in the US app download stores, also what we're seeing in Google trend traffic. And you can see here that searchers' interest in so-called Red Note is rising. This is the Chinese app called Xiaohongshu. It's known as the Little Red Book or Red Note. It's sort of an amalgamation of Instagram and also Pinterest. And that company or that app is absolutely surging in popularity. If you look at the US Apple iPhone's app downloads right now, you'll actually see Xiaohongshu or Red Note is number one. Number two actually is Lemonade, which is a company that's also owned by ByteDance, and it's another sort of social media app. But certainly the trends that we're seeing does still suggest that these around 170 million TikTok users in the US that are going to be affected by this are looking still possibly to migrate to other Chinese apps in the future.
Our tech reporter Annabelle Jewell is there in Hong Kong with certainly a very interesting development if we continue to see that playing out with the possibility of Elon Musk buying those US operations of TikTok. We are just hearing in a Newsmax interview with President-elect Donald Trump talking about a number of different topics, including on TikTok. He says he's not opposed to TikTok, so we'll see what that further commentary is. But he's also spoken a little about these ongoing negotiations when it comes to a potential deal on the Gaza war this week. Trump seeing the Israel hostage deal being done by the end of the week, according to his comments on this interview, or in this interview, I should say. And we have also heard from US National Security Advisor Jake Sullivan saying that there's a distinct possibility of a Gaza deal this week. And we have really seen developments when it comes to progress towards a deal to pause that 15-month war in Gaza. The negotiations really focusing on releasing hostages in exchange for Palestinian prisoners, with that deal potentially releasing 33 hostages in the first phase over a 42-day ceasefire there. So we'll continue to watch that. And Bloomberg has learnt that Donald Trump's economic team is discussing a gradual approach to tariffs to boost negotiating leverage and avoid a spike in inflation. Our senior editor, Derek Wallbank, joins us now for more. And Derek, the kind of most sort of compelling part of this report to me was that this hasn't been shown to President Trump, President-elect Trump, I should say. Do we know that this is kind of likely to be palatable? Because there have been kind of similar suggestions or reports being made before, and he obviously has to date wanted the shock and awe of big tariffs at the same time.
Yeah, Heidi, I think it's a really interesting thing. You know, we've talked before about the idea of whether Trump's tariffs threats are going to be negotiation starts or whether or not they're going to be full policy interventions, right? This is sort of, this would be an idea towards them being a negotiation start or a kickoff for further talks, right? Now, this has not been presented to Trump. Trump is the final decider in all of these things. And as I've mentioned before, and it really bears repeating, in a Biden administration, you see something like this and you say, okay, this is what's going to happen 95% of the time. In a Trump administration, he is the guy who makes the decision. But there are some heavyweight names who've been working on this plan. Scott Bessent, the nominee for Treasury Secretary, Kevin Hassett, who's going to be the director of the National Economic Council, and Stephen Mirren, who's nominated to lead the Council of Economic Advisors. So this is not three guys in their basement with a computer, right? This is three real people who have big names and big titles. So that is a level of seriousness, I would say, is involved with the discussions that are going on.
And of course, given the uncertainty, it just really makes the job of the Fed and any economic policymaker looking at the United States and potential tariffs much more complicated.
Yeah, you know, that's right. I think that a lot of people right now are looking at the U.S. hoping for a certain amount of certainty, and they're having to keep their play of potential options quite wide. This is something that I think that President-elect Trump is going to do almost by design. He likes to keep people guessing. He likes to have a certain field of uncertainty in there, and I would not expect anything different for the next 4 years. I would expect there to be a higher degree of uncertainty, maybe a higher degree of implied geopolitical volatility that people will have to deal with. And this is just sort of back to the playbook that we saw for 4 years prior when he was in term. But again, remember, he's had 4 years to sit there and prepare for this return to power, and now he knows how to leverage the systems of government probably more, and so you can expect this to be used. This is a feature, not a bug.
Bloomberg senior editor Derek Wellbank there. And another story that we're following very closely, President Biden's national security advisor Jake Sullivan warning of severe consequences if China launches a cyber attack that causes physical destruction in the US. He told Bloomberg the US has evidence that China is preparing for such an attack and that deterring it should be a priority for the incoming administration.
China is hacking the United States. There's the espionage part of that, like Salt Typhoon, and then there's the potential that China would actually use cyber means to physically disrupt or destroy critical infrastructure in the United States. And we've sent a clear message to China's leaders that if they did that, if they actually took a physically destructive cyber attack in the United States, that there would be severe consequences.
More ahead on the Asia trade. This is Bloomberg.
Bond yields across Japan rising. We're seeing the 10-year yield trading at around that 2011 high, and the 20-year yield also topping the 2% level for the first time since 2011. Of course, we're watching very closely that 40-year yield because we're around those record highs. We haven't seen these levels since the inception of the 40-year bond in 2007. So we continue to watch all of the bond markets, especially ahead of the BOJ Deputy Governor Ryozo Himino speaking later this morning. This is Bloomberg.
Take a look at what we're watching when it comes to Asian markets. A degree of caution, although we're seeing kind of bifurcated trading at the moment, with Japan stocks really slipping about 0.7%. Tech stocks seeing the biggest losses. We're seeing a downside of over 2.25% in particular. But we are seeing, with oil hovering at that 5-month high, energy across the board a bit higher in Japan. Energy stocks are up by close to 3% in the early part of the session. The Kospi is seeing some upside there despite the political uncertainty, the saga continuing to play out there. And here in Australia, we're off the session highs, but still some of the mining-related stocks, finance-related stocks a bit higher. Perhaps we're getting a bit of a boost from the assertions of confidence and the boost that we might see for Chinese equities and Chinese risk assets from the CSRC's comments that we had over the past couple of days or so. But we are also, of course, watching the broader impact of these Trump gradual tariff hike plans that are supposedly being considered at this moment, whether they could restore some calm to these markets. Let's get you back, though, to the UBS Greater China Conference in Shanghai, where our Chief North Asia correspondent Stephen Engel is there with our next guest.
You know, Heidi, one of the best things about being here in the heart of the financial center of China is to kind of read the room and talk to people here. There's 3,000 participants here at the 25th anniversary of the UBS Greater China Conference, and it's full of deal makers, all mulling around. And that's why our next guest is critical at this time as we begin the year and kind of wondering what kind of onshore and cross-border deals are in the works. And this is the place to be. Samson Lo, UBS Co-Head of M&A Asia Pacific, joins us right now. So it's been a bad past 3 years. I think M&A deals originating out of China fell about 10% last year, the third straight year of declines. Obviously, there's all kinds of issues, whether it's the slowing Chinese economy, there's a lot of caution here and spending, there's national security issues, all the gamut. But you're seeing a pickup What are you seeing for this year for China M&A, and then as it extrapolates to global M&A?
Okay. First of all, thanks for having me here today, Stephen. It actually has been a very interesting turnaround since the end of last year. For example, towards the end of last year, we saw a very, very sizable billion-plus take private of ESR, Hong Kong-listed ESR, by a consortium of private equity owners. And in the last 14 days, even we alone, we have announced 2 China M&A and closed 1 China M&A just in the last 14 days. So that's why I'm feeling increasingly optimistic about the China M&A turnaround. And in fact, I think towards the end of last year, I was predicting an increase of about 15% in 2025. Now I'm feeling good about it, and I'm thinking of revising it upward to about 20% plus this year.
So you are revising upwards.
I am revising
That's some
upward.
breaking news right there.
Yeah.
So again, those deals that you saw in the beginning part of the year, where the equity markets are absolutely, thrown into turmoil because of the Fed and just the ongoing lack of stimulus, you're seeing M&A deals picking up.
Absolutely. I would say that it's particularly for China M&A, it's driven by a couple of areas. One is there is continuing a lot of interest in take privates of Hong Kong listed companies. Now, we have seen in the case of the consortium with ESR, we have seen in the case of DCP Capital of Sun Art Retail, even announced on January 1. And we continue to have a big pipeline of Hong Kong listed companies that have suffered from depressed stock price. And at the same time, we are seeing, because of regulatory and possibly political reasons, there are multinationals divesting their China businesses. And likewise, there was a breaking news that we all noticed this morning, even for Chinese companies divesting or offloading an operation, a sizable operations that they have acquired in the past in the US or in Europe. And at the same time, there continues to be a lot of private equity interest in this part of the region, whether it's big buyout in the making or is divestment or monetization, which is something that we have really wanted to see more in the last few years, but we haven't seen a lot of divestment or monetization of portfolios in the last 2 years.
Now, national security issues obviously is sensitive here in China, but that has also prevented some deals from happening, whether globally, of course, Nippon Steel and U.S. Steel. Now the headline this morning is China is actually saying they're mulling whether to allow Elon Musk to buy TikTok. I know you have just a few minutes to think about that deal, and it is a sensitive issue. But how much is national security going to continue to be a dampener for M&A on sensitive issues like social media? TikTok, which has all that data, does not want to necessarily sell it to a entity that would put that data at jeopardy.
So I would say the national security and also regulatory concerns, in some way, even though we focus on the negative end of those, it actually creates more opportunities. And a lot of the cases, especially with sensitive industry, the most natural buyer would be one that is from the original country. Like, for example, in the case of TikTok, right, it does, if you think about it for a second, it does make sense for a U.S. buyer to be acquiring that business. So that is why a lot of these deals driven by regulatory and political concerns, in the end, it would actually open up more opportunities. And in the last 2 years, I would say that most of the cross-border M&A is actually designed this way. It's a Chinese company offloading a overseas operations that they have acquired in the past for many reasons, monetization reason or for political reason. And at the same time, it's also foreign corporations divesting the China businesses, again, for political reason or for monetization reason.
I guess Elon Musk is friendly to China. That might be a partner that could actually be acceptable to the Chinese government.
I would say that for that sort of deal, you would think that a U.S. person is more suitable as a buyer for the type of business. So, let's see.
Yeah, let's see, right. What's going to be the role of private equity? They started picking up, obviously, last year. What role in the Asia-Pacific and in China are they going to play in M&A this year?
They are playing a very, very significant role. For example, the deals that I have mentioned, ESR and also Sun Art, they were all in the end taken private by private equity firms. And especially when we look at globally, there is about like 3.9 trillion of industry-wide dry powder to be deployed. Obviously, they are not going to be deployed all in 1 year, but you will continue to see a lot of big private equity buyout in 2025. I would say that largely because of a stabilizing interest rate environment. Interest rate doesn't need to come down further, but as long as there is stability, it provides clarity and it adds to confidence. And at the same time, we haven't seen any sizable divestment or exit from the private equity firms in the last 2 years. So what what we are going to see this year is, yes, there will be some that are coming to the market, and for various reasons, coming to the end of the cycle, coming to the end of the fund life. So there will be private equity driving a lot of M&A. I would say that probably even 25% of our whole volume in Asia Pac in 2025.
We have depressed stock prices that could help fuel the M&A, but in America, what do you see the M&A getting on the wings of the Trump inauguration and the Trump administration, promising less regulation, lower corporate taxes, broadly a pro-business stance? Do you see it, M&A volumes surpassing what, $4 trillion US is one number that I saw, highest in 4 years, is one projection from another bank?
I would definitely say that overall environment is more optimistic, and with optimism it translates into more confidence among board levels and also among our shareholders. So we are going to see a lot of pickup in M&A dialogues and also exploring different structures. For example, certain markets, they are enjoying quite elevated share price improvement, so they will be exploring cross-border M&A using their own stock. So I would say that overall the environment that we are in is a lot more conducive than before.
And finally, just Southeast Asia, Japan, and Korea, all three of those markets picked up in M&A deals about mid last year. Will that continue?
Oh, that would definitely continue. Particularly in Korea, continues to be a market with a lot of private equity interest. Likewise for Japan too, activism, domestic M&A, and also cross-border M&A. Now they definitely will continue to look for cross-border M&A in areas that they think there will be less regulatory hurdles.
Samson Lo, thanks so much for joining us. Thanks for the scoop. You gave us breaking news here, guys. Early on in the interview, he's going to revise upwards his outlook for M&A deals in Asia Pacific or just China?
Asia Pacific.
Asia Pacific to 20% increase. Back to you.
Thank you, Steve.
Yeah, great conversation. Stephen Engelo, our Chief North Asia correspondent there from the UBS Greater China Conference. And we'll have plenty more of breaking news as well. Stay tuned for the China Show, exclusive conversations with the UBS Chief China Economist, plus the chairs of Sun Resin and AmCham Shanghai. This is Bloomberg.
Los Angeles and the rest of Southern California are facing a second week of fierce winds as two major fires continue to burn across the city. Fire crews have been struggling to contain the Palisades and the Eaton fires that have killed at least 24 people and scorched nearly 40,000 acres. The disaster is expected to be among the costliest in U.S. history, with estimated damage and loss between $250 billion and $275 billion. California Governor Gavin Newsom is proposing at least $2.5 billion in additional funding for emergency response efforts. And as the disaster in California continues to unfold, Australia is also in the peak of its summer bushfire season. The country's Climate Council says that carbon pollution is driving longer, more intense and overlapping fire seasons in both places. This is putting a strain on domestic resources as well as international cooperation, such as the sharing of large firefighting aircraft. Let's bring the situation here with Roslyn Prinsley, who's from Australian National University's Institute for Climate, Energy and Disaster Solutions. So, in a lot of ways, is it surprising to you that there's been such a lack of preparedness in these LA fires? Because we know that last year was the hottest year on record for the world. It was the second hottest for Australia. Should there have been more of a recognition that these fire seasons are now sort of elongated and overlapping?
Yeah, well, I think there's no question that fire seasons are going to be elongated and overlapping into the future, and things are only going to get worse, sadly. I think people are people, they put their heads in the sand until it becomes so desperate that they can't. And I'm hoping that these fires in Los Angeles will make people see that things are really desperate and we need to do a lot more than we've been doing. To my mind, we need to think about fires as the same way that we think about fighting wars and be super prepared for every aspect of firefighting to make sure, in my mind, that they don't happen in the first place. And that's the work that we're really focused on here.
And we know that for Australia, fire seasons are also going to be longer and less predictable. How do you rate the government and I guess state government and local government's preparedness when it comes to future fire seasons, both in terms of infrastructure, resourcing, human firefighter training?
So there's no question that local, state and federal governments take this extremely seriously. And have recognised now that there's a need to turn around that poor balance between preparedness and recovery. Up until now, most resources have been invested in recovery, and now we're putting a lot more resources into resilience. And so we have the Disaster Ready Fund, various states have their own preparedness funds. We're changing the way that we govern the management of disasters. And we're doing a lot. The problem, I think, is that we are not keeping up with climate change. Climate change is rapidly outpacing our ability to deal with disasters. We're actually facing a severe shortfall in funding for recovery efforts and for disaster mitigation. Our government resources are really, really strained. And unable to meet the demands that are growing due to those impacts of climate change on increasing intensity and frequency of disasters. And as well as that, our current approaches often address the symptoms, but not the root causes of disaster risk. To my mind, we lack really transformational solutions that can tackle the fundamental drivers of the challenges of climate change-fueled disasters head on. So we need to do a lot more, and we need to do it a lot more quickly.
How concerned are you about reversals and changes that we might see in the coming year, especially as we hear a Trump administration might not be as open to keeping some of those efforts and the progress that has been made from the Biden administration as well in this green transition and sustainable energy solutions as well?
Yeah, so there's two things. There's absolutely no doubt in my mind that we need to do everything we can to reduce our carbon emissions. But the sad thing is, even if we stopped emitting carbon tomorrow, which is, where the Biden administration, I guess, has been heading, even if we stop that tomorrow, which we're slowly getting there, but we're certainly not going to get there next year or the year after or anytime soon, we'd still have this build-up of greenhouse gases in the atmosphere that will still mean that these disasters are only going to get worse. So we need to, at the same time as we're reducing our carbon emissions, we need to start really strongly focusing on technologies to actually fight these disasters, because they're not going anywhere anytime soon. They're only going to get worse.
I know that you've been studying some new methods when it comes to how to implement technology in fighting the symptoms that we're seeing right now in terms of climate change. What are some of the most exciting areas for you?
Yeah, so for your listeners, as well as bushfires becoming more frequent and covering longer seasons, the nature of bushfires is changing with climate change, and we just don't really know how to fight these fires. And in fact, even the most experienced firefighters and fire commissioners are finding that the traditional tools that we usually use, such as hazard reduction burning and back burns, and just not working anymore. And so we need to find new solutions. And so I think we need to turn our thinking upside down and invest much faster in research to develop new technologies. And in our case, these fires, our fires in 2019-20, 90% of the fires areas burnt were caused by lightning ignitions in remote bushland. The problem is that you don't see them until they get really big, and by the time they're really big, they are too big to control, and then they spread into areas where you don't want them to go. And as well as that, they kill lots of animals, they cause lots of pollution. So what if we invested our efforts into finding these and putting them out when they're tiny? Can we detect ignition from the lightning and extinguish it before it grows dangerous? So the exciting things we're doing at the moment are trying to see if we can detect fires much more quickly and put them out straight away. And we have a Bushfire Research Centre of Excellence at ANU with researchers from many disciplines collaborating with industry partners to try to do this. And I guess I started out thinking two things. First of all, I noticed in Israel they have the Iron Dome, which is an air defence system that tracks and intercepts missiles to help protect and save lives there with all those rockets that keep firing into Israel. And they've saved many, many thousands of lives, I think, that way. And I thought, what if we had a system like an Iron Dome that could detect ignitions and put them out straight away, just in the same way as you stop a missile? So what we're trying to do is something like that. And I also thought about, we have astronomers with telescopes who are looking up at stars millions of light years away, and they can see them. And I thought, what if we turned that telescope down to the ground and to see if we could find tiny lightning ignitions and then work out some way to put them out straight away. So we've been looking at bringing advances in scientific areas such as artificial intelligence, sensor technology, drone technology, astronomy and engineering to produce things like networks of scout drones that can rapidly locate newly started fires, new kinds of detectors that can detect them. We're even developing GPS-guided water gliders to suppress small fires.
Roslyn, really great to have you with us. Roslyn Prinsley, who's a head of disaster solutions at Australian National University's Institute for Climate, Energy and Disaster Solutions. We have more on Australia Ahead every Tuesday. That's 11:40 a.m. watching in Sydney if you are, 8:40 if you're in Hong Kong. You can also tune into the Australia podcast at Bloomberg, delving into the biggest stories shaping the country's role in global business. You can find that at Apple, Spotify or Bloomberg.com.
And Haidi, Wells Fargo now saying that the insurance claims from the wildfires in Los Angeles could cost the industry as much as $30 billion. Bloomberg Intelligence lead APAC insurance analyst Stephen Lam joins us now to discuss the impact. And Stephen, of course, apart from the obvious destruction, what other factors are driving insurance losses from the LA fires?
Yeah, Haidi and Shery. So we think the strong wind is definitely a huge threat for the area. Imagine, sort of a hurricane force wind blowing. And, those winds were actually one of the major causes last week when Wednesday, when the fire got started and really exploded in the areas. So I think that's number one. Number two, definitely it's, where the wind is blowing. That's another factor. And number three, it's definitely which locations we're talking about. Are we talking about more in the Palladay area or in the Eaton fire area? Mind you that those fires are still largely uncontained. I think it's 33% in Eaton and around 17% in Palladay.
What level of exposure are we talking about when it comes to Japan's insurers?
Yeah, so, a lot of the insurance companies have tried to pull out or reduce the exposure in the California wildfires prone areas, and the Japanese companies included. But overall, they're roughly at about 2 to 3% in terms of market share, we believe. And we're talking about the top three: Tokio Marine, MS&AD, and Sompo. Now, the thing is, I think what's happening, in recent years is that there's a tug of war between higher insurance rates. But then, companies really try to hone in their risk in those really disastrous prone area. And in fact, those specific LA areas were called out a while ago by some of the, intelligence institutions. So we're thinking about low single digits.
APAC lead insurance analyst. Stephen Lam, we'll have to leave it there, but a great context when it comes to the insurance losses and damages that we're seeing, of course. More ahead on the Asia Trade. This is Bloomberg. Haidi, a lot of news that we're following in South Korea right now, especially as the Constitutional Court now begins the trial of President Yoon Suk-yeol on whether to really uphold that decision by Parliament to remove him from office. We're now hearing that South Korea's investigators and Yoon's security team are holding a meeting, that the investigators are asking Yoon's security team for cooperation. Of course, it's been a key question whether President Yoon would actually appear at this Constitutional Court in order to answer questions. The key concern for them is a potential arrest arrest as we continue to watch the Corruption Investigation Office for high-ranking officials, the police and the president's security team holding a meeting today.
Shery, we're also seeing some saber rattling from North Korea at this point as well, right? The South Korean Joint Chiefs of Staff conveying in a text message that North Korea has fired an unidentified projectile towards waters off its east coast. It's according to South Korea's Defense Ministry in this message that was sent. It comes about a week after Kim Jong-un and the regime fired an intermediate-range ballistic missile that prompted a national security meeting in South Korea. So there is a lot going on when it comes to that situation there as well. We heard last week Kim Jong-un saying that, claiming that the country's new hypersonic missile will keep rivals in the Pacific region in check. So we continue to watch that situation as it develops, but that is just about it for the Asia trade. Our markets coverage continues with the start of trading in Hong Kong and Shanghai and Shenzhen almost upon us. The China show is next.